Hi there, welcome to Kneppy Invest. I thought I'd do another state of the markets technical update video. And the reason I want to do this is because not only do I want to give you a bit of an update to how the indices are performing, including Australian indices like the XJO and American indices like the Dow Jones, Nasdaq, Russell 2000 and 3000. Also going to give a bit of an update to gold, uranium, coal, and maybe even Bitcoin. But another thing I want to do today is just look at some interesting tweets over the past few days. Now, every single day I go on Twitter, and in my opinion, Twitter can be the best source of interesting information. Now, some of that information can be opinions, but that's okay because I want to get a whole range of different opinions out there, particularly those who are bearish and those who are bullish about the future, in particular, the short to medium term future. So I'll go through about maybe 8 or so tweets that I do find interesting that can give us the different perspective on what the market's doing now, how the economies are performing as well. But let's focus on the XJO right here. And the first thing you notice when you look at the XJO is absolutely zero trend. And that hasn't changed over the past 2 weeks since last time I did one of these videos. And I do expect a really good day on Monday. So I'm recording this video at 9:22 a.m. on Sunday, the 4th of June. And I expect 5th of June to be a really good day because of what happened on the American markets. In particular, the amount of jobs was almost double than expectations, even though unemployment rate went up. And the first thing we have to look for in case of a recession is increasing unemployment. And if unemployment keeps on increasing in America, there's a chance they might declare themselves in a recession. That's just a possibility moving forward. So when you look at the XJO, no trend. So this is telling me straight away that the bears and the bulls are fighting each other and no one's winning. It's a stalemate right now. Typically, the bulls win over time. But right now, the bulls are, say the bears are skeptical about the next, say, year or so in terms of what the economy is going to be doing. And we know the overall market is a little bit skeptical because of the yield curve inversion, which I might touch upon during this tweet session later in the video. So the XJO, no trend, which is fairly similar to the XSO, which is the small ordinaries. No trend here either. What I'm waiting for is a bit of a breakout to the upside, which is or would be above about 3,080, or on the bear side, a breakdown below 2,600, which will be below the two lows we saw in June and September of last year. So at this point in time, no trends in the Australian markets, which is a little bit different than the American markets, which Nasdaq shows a pretty good uptrend, burst through a resistance level a few weeks ago, and has kept on climbing. And the majority of this bullishness in the Nasdaq is because of a few companies, which I touched upon in my video 2 weeks ago. Now, in saying that, the Dow Jones had a really good day on Friday, up 2.1%, the best day they've had since, I think it was January. There was a really good day here in January. Or maybe I'm thinking of another day. There was a really good day. I did see, yeah, 6th of January, up 2.13%. And so that day on Friday, up 2.12%. So just missed the best day of this year. But when you look at this really good day on the Dow Jones, this does not set the Dow Jones into an uptrend. It's just, in this sort of sideways trading pattern. So even though it was a good day, it doesn't do anything to change my opinion on where the Dow Jones is compared to the Nasdaq. Now, the S&P 500 is a little bit more bullish just because this index does have some of those big tech companies in it, and that's why the S&P 500 has broken out and now is at the end of Friday, is at, or in that sort of resistance zone. So if you look at these highs back in, was that August last year? Now, even though I'm putting a line, just think of those highs back in August as sort of a zone. And the S&P is in that zone right now. So there will be some resistance moving forward for the S&P, but this does definitely look a little bit more bullish than, say, the Dow Jones. Now, the other two I want to look at are the Russell 2000 and Russell 3000. First, we'll have a look at the Russell 3000. Now, the Russell 3000 is sort of like the 3,000 biggest companies in America. And this, again, just like the S&P 500, fairly similar, has broken out. So this, if you compare this to the S&P, fairly similar. But when you look at the Russell 2000, and I always get this wrong, the Russell 2000 is the smallest 2,000 companies on the Russell 3000. So in a way, this is looking at the smallest companies in America, sort of like a smaller cap indice. And this takes out those big companies, those Apples, Microsofts. So we can just see how similar this is to the XJO and the XSO in Australia. So this bullishness, when we are looking at the Nasdaq, even the S&P 500 and the Russell 3000 is being caused by the biggest companies, because this is a fairly negative, not negative, but a sideways pattern right here, even though the Russell 2000 was up 3.6% on Friday. Now, even though it was up 3.6%, the trend has not changed. It's still going sideways in a sideways trading pattern. In fact, it had to get above about 2020 for me to become even a little bit more bullish about this particular indice. So that's really all I have in regards to the indices. Hasn't really changed from 2 weeks ago. Nasdaq is still in the bull run, and those companies that have led the Nasdaq, the Nvidia, the Apples, Microsofts, are still trending higher. Those are the companies you want to be in right now. However, when it comes to Nvidia, I do have a tweet that is very interesting, looking at the past, in particular comments from a CEO of one particular company in terms of price of sales, because the price of sales of Nvidia is ridiculously high right now. There is no way anyone could say to me that Nvidia is not overvalued at current valuations, even though the growth profile for the company is quite strong. So let's have a look at gold. Now, these are all daily charts, not looking at the weekly chart. Gold did have a negative day. So this would be on, let me just move this would be on the Friday. Yep, Friday. So this is sort of understandable. The overall market in America had a good day. Gold had a pretty bad day, down 1.5%, but that's okay. Trend is still up. The sort of the medium-term trend is still up from those lows back in late last year, but the short-term trend is down. We don't want to see gold fall any further than about 1940, because I think it does fall below 1940. That will be fairly bearish. And what we want to see is to get above 2060, which is that very, very strong resistance level. And if we look at the weekly chart, you can see, and if you've seen it in my videos on gold, you know that level is strong because both times it's hit it in the past. In fact, 3 times now, it's hit that level in the past, it's pulled back. So traders are seeing, or whenever they see gold hit that level, they sell. We know it's a very strong, the other reason we know it's a very strong resistance level is in these 1 week candlesticks back in March of this year. And then again, in the last few weeks, 3-4 weeks ago, we saw a long shadow to the top of that candlestick, which is telling us there's a lot of selling coming in when gold gets up to that level. But if gold breaks above that resistance level, that will be a very bullish sign. And all those traders who would be selling more than likely would be buying. Technicals work. So a lot of traders use technicals, and that's why it works, because they use it. Now to uranium. So this is a weekly. Uranium, bullish. That's all I can say. Not only is uranium bullish, I am possibly going to take a position in this company, Boss Energy. What have we got? Stocks. And remember gold, how a particular level was fairly bullish, and every single time gold got to that level, we saw a bit of sell-off. The same thing is true for Boss Energy. So this is a weekly chart, and really look at from say the mid 2021. Whenever Boss Energy got to $3, we saw it sold off. So it's happened 1, 2, 3 times in the past. And that means that level at $3, it's a round number as well. And round numbers tend to be fairly strong resistance and support levels. So we saw it hit, Boss Energy share price hit that level 3 times in the past. And it's right above that level right now. So if we look at the daily chart, we can see the share price of Boss Energy pulling through that resistance level on good strength, good volume on the Friday. It needs to remain above that level. So if I said the share price sort of tickle $3 and then starts moving higher, that will be a good sign that $3, the resistance level has been tested, And now possibly you could call $3 a support level. So a possible, I'm just calling it a possible breakout in Boss Energy. So a possible buy that I might make on Monday. I haven't decided yet. Bitcoin, let's have a look at Bitcoin. I haven't actually had a look at this, but nothing too exciting here. Still in an uptrend. I'd like to see this start to move higher soon and really get above 31,000, which was the highs we saw back in April. But I think if that does happen, and who knows what would cause people to get interested in Bitcoin. I have no idea what causes any rallies in Bitcoin. I think the last rallies we did see was on the back. I forget exactly why. There was definitely a rally in Bitcoin because, oh, that's right, the banks, because of weakness in the banks, of Silicon Valley Bank going under. A lot of people were concerned about their wealth or whatever, and they decided to rush into Bitcoin and gold. And that's why both of those assets started to move up. And so that was at the beginning of this year. So who knows what's going to happen in the future with Bitcoin. Anyway, that's for you to decide. Still negative on copper. Has had a nice run in the last 6 days, but it's still in a downtrend. And let's have a look. I've already talked about Russell 2000, 3000. Let's have a look at Hang Seng down, still in a downtrend. Here it is. Coal. That's the other thing I wanted to look at. Coal. So coal, it looks ugly. So falling down and down, keeps on falling. It's moving towards this level at $120. The reason $120 is important because in the past, that was a really strong resistance level, and it pulled through there in May 2021. The reason why I'm looking at that level is because that were the highs of coal in the past, particularly in 2017 and 2018. And not only that, if you look at some of the coal companies on the ASX, you'll notice these are not the sort of companies you want to be in right now. I forget where I put these companies. Yep, it's in mining. So for instance, we look at the daily charts for these. Stanmore looks ugly. So this is starting to look ugly. Yancoal has really taken a nosedive recently. Look at that nosedive. Even though if you had a look at some of these, dividend yield of 34.6%, price earnings ratio 1.65. So if you're just judging these companies based off the dividend yield, price earnings, you might be rushing out and buying it because, wow, what absolute great value there is. There's a reason why the dividend yield is high, the price earnings ratio is really low, because the market knows that the earnings for these companies are going to nosedive because what's happening with coal. That's why the share price of all these companies is dropping like a rock, because of what's happening to gold prices. And that's why this is sort of like a dividend trap, dividend yield trap, whatever you want to call it. So Yancoal looks really ugly right now. I'd definitely be selling if I was in that. Whitehaven looks ugly. I think all these companies look ugly right now. But the other thing I wanted to show, particularly when we look at, say, Whitehaven, is if we look at the weekly chart. So remember, the price of coal is moving towards those old highs we saw back in 2017 and 18. So look at where the share price is now for Whitehaven. It's getting towards the highs we saw back. In fact, it's just fallen below the highs we saw back in 2018. So this makes sense. So the price of coal is now moving towards the highs we saw back in 2017 and 18. And the share price of Whitehaven coal is now at those highs we saw back in 2018. It all makes sense. Maybe the same thing is true with New Hope. Let's have a look. Yep, New Hope is right on those old highs we saw back in 2018. It all makes sense. The price of these mining companies is highly influenced by the price of the commodity they are mining. It all makes sense. So there's no reason to be holding these companies right now because the price of coal is falling like a rock, and it could fall much further from here. What's this one called? TAR. Terracom, that's right, falling like a rock. They're all falling like a rock at this point in time. Now, interesting enough, I'll just show you some of these American companies. So I have been sort of negative when it comes to Tesla, but here's an interesting thing. So let's have a look at NVIDIA first. So NVIDIA has just gone silly. It's gone gangbusters. We have seen a little bit of weakness in the last few days. Well, maybe not weakness, but it's not really a lot of volatility there. But market cap of this company is almost $1 billion. Price to earnings ratio 207, earnings per share 1.94. So dividend yield 0.04%, but the price earnings ratio 206.7. 206.7. So in the last year, they had $26 billion, or we'll say $27 billion of revenue. Previous year before that, $27 billion. So in fact, this company didn't grow their revenue from 2021 to 2022, although they should grow their revenue in the next year. So the price to sales ratio of this company is stupidly high. So we're saying it's probably about 40, probably a little bit under 40. And then there was, I saw this tweet here. So this is a letter from the Sun Microsystems CEO just after the dot-com bust, talking about how ridiculous it was that people were paying such a high price to sales ratio for this company. So at 10 times revenue, and remember that NVIDIA is trading at about, what was it? We'll say 35 times revenue right now. So at 10 times revenue, to give you a 10-year payback, I have to pay you 100% of revenue for 10 straight years in dividends. That assumes I can get that by my shareholders. That assumes I have zero cost of goods sold, which is very hard for a computer company. It's very hard for any company. That assumes zero expenses, which is really hard for a company with 39,000 employees. That assumes I pay no taxes, which is very hard. And that assumes you pay no taxes on your dividends, which is kind of illegal. And that assumes with zero research and development for the next 10 years, I can maintain the current revenue run rate. Now, having done that, would anyone of you like to buy my stock at $64? Do you realize how ridiculous these basic assumptions are? You don't need any transparency. You don't need any footnotes. What were you thinking? So what the CEO was saying is, why were you paying such a high price to sales ratio or price to revenues ratio for my company? It was ridiculous at 10 times revenue. That's what he's talking about. 10 times revenue, not 35 times revenue, which NVIDIA is trading right now. Now, you could argue on the flip side that NVIDIA is going to significantly grow the revenue over the next 10 years. Significantly. And they would have to significantly grow their revenue to justify the current valuation. So that's a really interesting look back in history at what happened during the dot-com bubble. Now, everyone thinks the dot-com bubble was only those companies that were in the internet with .com at the end of the name. But companies like Microsoft, General Electric, computer companies, all of these companies had really high P ratios back then. So it wasn't only .com companies, it was most companies in America who had really high valuation. That's why it was a bubble. It didn't only affect a small subset of companies on the Nasdaq and the New York Stock Exchange. So we'll get rid of that. And now we'll have a look at some other, we'll have a look at Tesla. So I think I mentioned, I was thinking Tesla is starting to look a little bit more interesting. So let's just put a line, go to these highs. So if Tesla can get a little bit higher on the Monday trading in America, this could be breaking out, getting above the recent highs we saw back in February. And if it does that, the share price of Tesla could be moving into a new uptrend. Now, I wouldn't be buying this because I think Tesla's valuation is going to increase significantly over the next few years. This will be just based off sentiment, because sentiment does drive Tesla share price higher and lower. And this is definitely a cult stock on the Nasdaq. This is probably the cult stock, the biggest cult stock in history. That's just my opinion. And I think you have to have a pretty good argument to argue any other company has had a bigger cult-like status in the world. Tesla, but I'm willing to trade this company simply because of technicals, like possibly a breaking out pattern we are seeing with this company right now. Okay, so that's really all the technical updates I want to show you. Let's have a look at interesting things on the Twitterverse. I think that's a thing. When stock market closed on weekends, yeah, well, I'm not like this, to be honest with you. I would like stock market to be trading 365 days a year, but I don't think that's possible. In fact, I'd like the stock market to be trading 365 days a year, 24 hours a day. That would be absolutely awesome. But again, I don't think that's possible. Anyway, so yeah, I sort of like this, but I do appreciate the 2-day break to have a look at charts, that sort of thing. And that is the thing I do on the weekends, on Saturday and Sunday. I look at charts just to see if there is any interesting charts out there And I found one with Tesla, I found one with Boss Energy, that sort of thing. So we get rid of you. Okay, what's this? This one is from Michael J. Kramer. So I follow a lot of people on Twitter. The Nasdaq rose 1.3% today, but there were 41 more new lows than new highs today, and the cumulative number of new highs minus new lows just continues to drift lower. So there's more companies reaching a new low than new high, which is telling us that the increase in the Nasdaq is being driven by just a few companies. What we want to see is a majority of companies increasing when we're in a bull run. Now, I did not think this was a negative thing, but I have read other stuff that this is a negative thing. You want good breadth. You want, when the Nasdaq is running hard, you want all the companies in the Nasdaq to be running hard with it, not just a few companies. And apparently this is a sign of weakness in the market. So Michael J. Kramer tends to be a little bit more bearish. I'm neither bearish nor bullish. I like to get all sides of the story. This one here, the S&P 500 is more concentrated than ever. In fact, Apple and Microsoft alone now account for nearly 15% of the S&P 500. And then if you include companies like the other companies like NVIDIA, this would be even greater. Yeah, here I thought 2000 was a big deal. 2000 was not. 2000 was 10%. I'm not sure how to define S&P leadership. Is it only two companies or is it a few? Yeah, weight of the two largest companies. So I say, so the weight of the two largest companies in 2000 was 10%. Now it's 15%. It's understandable because these are powerhouses and they will continue to be powerhouses. Apple, Microsoft, even Alphabet are powerhouses. You could break up these companies, and particularly like Amazon. In fact, if you broke up Amazon into Amazon Web Services and then like their retail section, I would just hold Amazon Web Services. But some of these companies could be able to be broken up, and those broken up parts would continue to grow at really good rates. I'm very bullish on Microsoft as well, very bullish on Alphabet, very bullish on Apple. I think Microsoft and Alphabet are not telling us what they're doing in terms of research and development in AI, and there's no reason for them to tell us what they're doing. So I thought that was very interesting that we knew this. I think we knew this. It's more concentrated than ever. Maybe not than ever, but we knew the Nasdaq or the S&P 500 was becoming concentrated. Market expectations for fund rates. Oh, I'm going to show you this. So let's go back to the market. So, and let's have a look at the 3 months. So this is the 3-month yield, the bond yield. So it keeps on growing. It's up to 5.4%. Now the US 10-year is sort of going sideways. So what you can do, and this is what you can do, is just put this in a line. The US government 10 years, get rid of these, and then you can overlay the 3-month. Well, what I should have done there is the complete opposite. So what I'll do here is I'll go to 3-month. And then overlay the 10-year. Okay, so what I'm doing here is looking at the yield bond curve or the yield curve. And whenever you see this orange line, which is the 10, this is the 10-year, below the 3-month, that means there is a yield curve inversion. So you very rarely see it. And right now it's actually increasing, the yield curve inversion very slightly. It's increasing, but it's still inverted. Inverted back in November, sort of inverted back in, November. And was sort of, it inverted for a brief period, inverted back in January, uninverted for a very small period or short period in March, but has been inverted for the last 2 months. And it remains inverted because the shorter term bond yield keeps on rising, but the longer term keeps on sort of going sideways. So let's go back to this tweet. So what's this tweet saying? Because the long-term bond yields are really low, the market is saying they expect interest rates to fall. So this is the market expectations for Fed runs rates or the interest rates until January 2025. So they do expect interest rates to climb a little bit more from here and then start falling towards the end of the year. And during 2024, the bond market expects interest rates to fall from about 5% all the way down to 3.5%. So they see significant dropping in interest rates. And I'd say at this point in time, the only way we're going to see significant drops in interest rates is if we go into a really bad recession, maybe even a depression, but a really bad recession. And that's what the bond market is thinking right now. They expect significant drops in interest rates. So in a way, they are expecting a significant recession. And then this guy, Charlie Bellello, says, June 14, a pause. June 26, a 25 basis point hike. Then from November 1st this year, that's when they expect interest rates to start being cut. So November this year. Let's see if the bond market is right. Bond market tends to be fairly smart, and they can be right a lot of the times. Not all the times, but a lot of times. On to this whole that the market is ruled by just a few companies. So this is from Jesse Cohen. The top 20 stocks in the S&P 500 contribute to most of its return. So by weight in the S&P 500, those top 20 companies are 29.2% of the weight. But in terms of return, the vast majority of the return, something like 90% of the return, is because of those top 20 companies. And then if you look at the top 7 companies, it's going to be even more contrasting. So those top 20 companies include Apple, Microsoft, Amazon, Alphabet, Nvidia, Tesla, Meta, AMD, those sort of companies. So this is just telling you that the best returns in the market are being driven. In fact, the majority of the returns in the market are being driven just by a small group of companies. And I think I've shown you quite a few interesting stats in regards to that. Now on to what was really interesting. This is a tweet from actually, that's not interesting there. So this is in regards to what happened on the employment market in America. So the economy added 339,000 jobs in May. The expected number was something like 180,000. So significantly higher amount of jobs added in May. But unemployment went from 3.4% to 3.7%. Now, if we didn't see that amount of jobs added in May, I would be thinking this could be the signs of the recession coming. Because one of the things the board is looking for, and there is a group of people who decide if America goes into recession, and one of the things they will be looking for is increasing unemployment. So this could be the first sign that officially America could be going into recession soon. So the question is, why or how did unemployment rise to 3.7%, but the economy added significantly more jobs than expected? So sort of in the comment section, there was a lot of debate about that. I have no reason. Some people saying it's just because people are adding second jobs because of interest rates, cost of living pressures. They need second jobs, and that's why there was significant increase in jobs, but the unemployment rate rose in the end. Now on to the last tweet. This is from an Australian, Owen Rusk. Rusk Media. He does also iPods, host of Rusk, ASA, Self-Wealth, and more. Now this week, and there's just one little point, one little nugget I found interesting here. This week I'm joining Pete, Rare, Unit, Morgan to talk more land taxing in Victoria. Don't care about that. Some meaningful progress in build to rent. Don't care about that. Why there's bugger all listings right now. So I'm going to actually listen to this podcast simply because I want a little bit of debate on this. Why are there no companies listing on the ASX right now? And I'll just show you this little site I go to all the time, which is 61 Financial, goes through all the listings on the ASX. There were 2 listings on the ASX in May, 2. If we go back to say late 2020 into 2021, we're getting 20 to 30 companies listing, maybe even more than that, listing every single month. We had 2 in May, 1 in April, 1 in March, 1 in February, 6 in January, and about 7 or 8 in December. And when you look at some of these companies that are listing, the majority of them are lithium companies. So this one company here is called Augustus Minerals. And in the summary, you can see what they're doing. Exploration company exploring for lithium, rare earths, and copper. Well, you know why they're going there. Last month, we had The only company listing was Evergreen Lithium. Well, we don't even know. Have to look at their summary to know what they're doing. And then in March, we had one company listing called Lewin Metals. I can almost guarantee you, lithium. Well, actually, no, securing critical metals, nickel, copper, PGE, and lithium. And then if we go to February, one company listed, SQX Resources. I'd say 70, 80% chance they're in lithium. Oh, gold and copper. So a little bit different. Gold and copper. And then some of these other companies in January, HTM, a company called ACDC Metals, Dynamic Metals, Gold Hydrogen Company, Accusensus. I talked about in my previous video. So HTM, High-Tech Metals is cobalt. So, yep, same sort of ACDC Metals, probably in heavy mineral sands and rare earths. Dynamic Metals in nickel, gold, hydrogen, hydrogen exploration. Accusensus, the last real non-mining company we have seen listed on the ASX, apart from one, which I'll show you in a second. And Accusensus is that company that puts all those cameras, those cell phone or mobile phone cameras, to make sure you're not looking at it when you're driving. So probably potentially one of the most hated companies on the ASX, just because of what they do, not because of their financial performance. And the last one is VHM Limited, Rare Earths Exploration Company. Now, there was one other company listed this month or last month, and that was company with the code LNW, Light and Wonder. Market cap 90 million. Had no idea what this company is, but here is financial review. Light and Wonder Greenlight's ASX listing. This is a Nasdaq listed gaming business, which will begin trading or began trading on the ASX in May. The reason they decided to list on the ASX or have a dual listing, finally confirmed its secondary listing to give the business access to new long-term Aussie institutional investors and a bigger profile in one of its key gaming markets. Then I went to their ComSec website. Very little trading in this company. Whoops. Very little trading. LNW, Light and Wonder. Very little trading when it comes to this company. So it's been traded for 5 days. Share price at $90. Says the market cap is 90 million. I'm a little bit dubious about that. LNW. I wonder if there's Light and Wonder. So Light and Wonder on the Nasdaq has a market cap of $5.7 billion. So there's no chance the company has a market cap of $90 million. And let's have a look at the chart for this. We get rid of putting these two. There we go. So this company has revenue in the last financial year, revenue of $2.5 billion, but loss $1.25 billion. It's one of the things I don't like about American companies is even though they generate massive amounts of revenue, they're still loss-making. One of the reasons they're loss-making, all these companies, is because the amount of shares they give their employees, that sort of thing, share-based compensation, it's extreme over there. It's ridiculous. And that's one of the reasons why these companies can have a lot of revenue but not profitable. I just don't understand how you can have $2.5 billion of revenue but still loss-making. And people argue with me, it's just because they're spending so much money to grow in the future. But why can't you spend a little bit less money, become profitable, and still grow at significant rates? And if they can't do that, that means they don't really have a competitive advantage over anyone else. So that's one thing I have against some of these companies. Anyway, so that's probably the only interesting company, apart from Accusensus, that's listed on the ASX this year. So only two. So I'll be listening to that Owen Rask podcasts explaining why there's been so few listings, apart from a few lithium companies and rare earth companies. I don't think this goes back more than a year. There was another website that I did have a look at that's no longer in existence. They could go back 7 or 8 years. and you can see all the listings in each particular year and how the performance of these companies did. So that's really all I've got for today's video technical update. If you have any questions or thoughts, just leave those in the comments section. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.